Ladies and gentlemen, this is your premium business show, Business Redefined. We are privileged to have exclusive access to the IMF Managing Director, that is Madam Kristalina Georgieva. It's a privilege to have you on set.
Thank you very much for the invitation.
You are in Kenya, you've met the president. What sort of policy conversations are you having with the key policymakers?
Let me first say that it is wonderful to be back in Kenya. Beautiful, dynamic, and with a great deal of change happening since I last came 5 years ago. The meeting with the president and the cabinet members was focused on how Kenya can overcome the exogenous shocks it is experiencing. We know that as a result of COVID and the war in Ukraine, inflation shot up, interest rates jumped, and countries like Kenya found themselves like innocent bystanders hit by those shocks. For Kenya, what it meant was no access to international markets for now, and therefore a pressure to withstand this funding squeeze that has come as a result. We have a very strong program with Kenya. We are financing now, and we intend to expand by deploying a new long-term concessional financial instrument. We have created the Resilience and Sustainability Trust. There will be a team here next week to work on that. The issues we concentrated on were three. First, fiscal position of Kenya. I want to give my strongest support for the decisiveness of the government to make sure that at the time when there is no access to international markets, the fiscal position of Kenya is strong. There is a budget proposal that puts Kenya in a very prudent position. Second, we talked about pressures that are coming through exchange rate. When interest rates are high, dollar-euro denominated debt, and the currency depreciates as all other currencies in the region have done, managing the exchange rate is a very important policy objective. Our recommendation is to allow the exchange rate to move. Why? Because protecting it means depleting reserves, and the country needs these reserves for its own imports as well as for the servicing of debt this year, next year. Third, we talked about growth opportunities. Kenya has the significant potential to leapfrog. It has proven it with M-Pesa, and it is a country where the investment climate is good, and therefore investing in Kenya, domestic investments as well as investments from outside, offer the chance for the country to do much better. We see in Kenya remarkably strong policy coherence, and that is what we hope to benefit you people here in Kenya in the years to come.
Madam MD, we've just come from a conversation about trade and integration. When you look at an economy such as Kenya, and especially within the context of the geopolitical fragmentation we're seeing globally, how do you think we can leverage trade to build on resilience?
That was one of the topics we also talked about with President Ruto and members of the cabinet, because we know that Africa is not taking full advantage of the benefits of trade. Neither intercontinental trade nor trading with the rest of the world. Most of the exports from Africa are still commodities. That clearly is not the way to go. And intracontinental trade is suffocated by high tariff, but especially high non-tariff barriers. Policymakers on the continent have taken a very important decision in 2018, the Africa Continental Free Trade Area. We have seen remarkable support. 44 countries have ratified. Out of the 54, almost all countries of the continent that have signed. And now is the time to accelerate the implementation of this agreement. We have assessed the potential of implementing it as lifting intracontinental trade by 53% if trade tariff and non-tariff barriers are eliminated and transportation, logistics, and other barriers are eliminated. We also see potential to increase trade with the rest of the world by 15%. Most importantly, we expect real incomes to jump by 10%, poverty to go down up to 50 million people. These are very significant numbers. We also are looking into ways to capture trade that is taking place but is not recorded. It's not in the data. And create incentives for those who are in the informal economy to step into it by access to finance, access to social services, and as we heard from our minister from Kenya, through cross-border payments. For me, I wouldn't look at the fragmentation in the world as an obstacle. I actually would look at it as an opportunity, because when there is shifting of all these moving parts, a newcomer can take advantage to build regional supply chains, to integrating global value chains. And I also see in Africa hugely important objective of integration, especially of agri products, because of climate change. We have seen how dramatic floods and droughts and hurricanes have become. Unless the region diversifies agricultural production and integrates more, that would translate into pain and suffering for people. The flip side, it is a great opportunity for Africa to have climate resilient agriculture and integration in trade.
How do you assess the progress of the sovereign debt roundtable? And I'm asking that because we are speaking this, of course, from an African context. And one of the recurrent requests has been the possibility that the moment a country triggers the conversation about debt restructuring, we should suspend the monthly debt service obligations. How do you assess that progress?
We have to recognize that in the last decades, the creditors' landscape has changed dramatically. Both public sector creditors, there are many new creditors that were not there before, and private sector creditors. That made debt management much more complicated, and that resolution really difficult. The G7, G20 discussions around debt have all led to a very strong mandate for the IMF to step up work on debt resolution. We have the common framework that currently has only benefited Chad. It is about to benefit Ghana, Zambia, and not too far in the future, Ethiopia. And what we see are three problems to be solved. The first one is timeliness. There has to be predictability from the moment the country asks for a treatment until that resolution is achieved. Second, incentive to creditors to act faster by providing debtor countries with debt service suspension from the moment they ask, the point you made, and I completely agree with. And three, currently only low-income countries are eligible, but we have seen countries like Sri Lanka in need of that treatment. This spring meetings in Washington, we brought together for the first time the global sovereign debt roundtable participants at the highest level, the level of ministers of finance, central bank governors. It is very important that it made progress. Why? Because for the first time, we bring around the table representatives of traditional creditors, Paris Club, of new creditors, China, Saudi Arabia, India, Brazil, of private sector, big institutional investors, as well as organizations of private sector lenders, and debtor countries. So we had a very constructive discussion. I was very encouraged to hear from the private sector, from China, a commitment for this to work, because the debtor countries suffer, but the creditor countries also suffer if they cannot rely on ever being paid.
My final question, Kristalina, is we've spoken a lot about the funding squeeze, and I know IMF might not have a crystal ball, but when do you project, for instance, we could begin seeing easing out of the global financial market conditions?
Well, the difficulty the world faces is a combination of slowing growth and stubborn inflation. We project this year global growth to go down to 2.8% from 3.4% last year. In Africa, down to 3.6% from 3.9% the year before. And unfortunately, this slow growth, weak growth is expected to continue in the medium term. Actually, we project average 3%. And at the same time, while we can say inflation picked up last year, 8.7% global inflation, it is now 7% this year. We don't see inflation reaching central banks' targets until all the way in 2025. So that means that countries have to brace for this slow growth, high inflation time, and be disciplined. Bring inflation, and we discussed this with the Kenyan leadership. Bring inflation down, keep it down. Be very prudent with what you spend money on because of this squeeze. And above all, invest in structural reforms that would open up opportunities for higher productivity, higher growth. In Kenya, one thing that I admire is the commitment to education, because skills win in a world of rapid change.